In this episode, we discuss global factors impacting REITs, megatrends, global economic growth, forex and hedging, and other exogenous factors. Megatrends. We'll talk about two trends, the travel bug and the AI wave. Han Kim-Siew is the CEO of OUE REITs Management, with a portfolio of commercial properties and hotels.
We do believe the secular trends going forward is there's a rising middle class globally and especially in Southeast Asia and Asia. So what that means is when you have shelter, when you have food, people travel. And when they travel, they will initially go to nearby destinations and then eventually further out. So hospitality sector should, we believe, perform very well over the next 3, 5, and even 10 years. So we want to be well positioned for this secular trend. How are we able to do this? By growing our income from 33 to 40%. That is our target. Visitor arrivals in Singapore were 13.6 million last year. Forecast to be 15 to 16 million arrivals this year. Now, the 2019 number was 19 million. So we're still short of that 19 million. So in the near term, we will see RevPAR growth coming through from increased occupancy. Over the longer term, we'll see that demand come through strongly because of this secular trend. So ideally, we'd like to move our hospitality income to 40% over the next few years.
The Digital Core REIT specializes in data centers. So we asked John Stewart about this specialized asset class.
So our philosophy is that we're basically providing the picks and shovels to the technology gold miners. And by that, what I mean is we own the infrastructure, right? We own the assets. Data centers are effectively the factory floor for artificial intelligence. And so not only do we have exposure and leverage to these technology trends, but we're backed by hard assets. We actually own the freehold to 100% of our assets. That really provides us and unit holders an opportunity to capitalize on the fundamentals that are driving very strong demand for data centers. At the same time, we're also blessed that the current environment supply is quite constrained. So you have a unique situation where you've got very robust demand drivers, at the same time supply is constrained. Again, we think that we provide a unique opportunity for investors to capitalize and ride the wave of these significant technology trends, obviously the latest and largest of which is artificial intelligence.
Global factors. 2023 and 2024 are years where the geopolitical backdrop affected major Asian economies, causing local issues that have to be navigated by REITs, including a couple of those listed on the SGX. For instance, China's 3 red lines, although aimed at residential developers, is one of the reasons the economy has slowed. Property development and its supply and value chain accounts for almost a third of Chinese GDP. As REITs with Chinese assets have faced challenges, EC World REIT has been suspended since August 2023. Global economic growth. The baseline forecast is for the world economy to continue growing at 3.2% during 2024 and 2025, at the same pace as in 2023. A slight acceleration for advanced economies, where growth is expected to rise from 1.6% in 2023 to 1.7% in 2024 and 1.8% in 2025, will be offset by a modest slowdown in emerging markets and developing economies from 4.3% in 2023 to 4.2% in both 2024 and 2025. Central banks' policies to support the economy, lower inflation such as raising policy rates, adversely impact the valuation of REITs and offset any gains from rental growth. Forex and hedging. With all but around 3 REITs owning foreign assets, hedging becomes an important part of capital management. The most popular formula is to use debt to acquire assets in another country. If the REIT is buying Japanese properties, the REIT is likely to use cheaper yen loans, which is what REITs with foreign assets are doing. The income is hedged on a 6-month rolling basis.
Elite UK REIT is also listed on the Singapore Exchange, but we are listed in sterling pounds. As such, we do have what we call a natural hedging in terms of the dividends that we pay, that's in sterling pounds. the debt that we take that's in sterling pounds and the rentals that we receive in sterling pounds, ensuring that the unit holders are not exposed to any currency risk. We do not have to hedge across foreign exchange.
Other exogenous factors: the difference between US and Singapore office REITs. As REITs pay out depreciation, the downside of this model was demonstrated by Manulife US REIT's distress and recapitalization. And in Keppel Pacific Oak US REIT's statement following the suspension of its DPU, its manager said US office requires a substantial amount of capital to build out and lease office space because the landlords, rather than the tenants, are responsible for funding the tenant improvements in addition to funding new or improved tenant amenities, leasing commissions, and other costs. This is very different from the Singapore office market. Therefore, office REITs that invest in US requires more capital investment than office REITs that invest in Singapore. Without the necessary capital investments, US landlords' ability to retain tenants and attract new ones will be greatly compromised, thus leading to a decline in occupancy and net property income, resulting in valuations declining even more significantly. Investing in REITs with overseas assets is not without risks. Once again, capital management is key. The REIT managers need to have sound capital management strategy. And that's it for today. We'll see you in the next one.